Get ready, crypto fans, because the market is absolutely exploding with developments you need to know about. We're talking about massive shifts, game-changing inflows, and strategic moves that are reshaping the entire digital asset landscape. The pace is relentless, the action is non-stop, and if you're not plugged in, you're missing out on the biggest stories of the year. Today, we've got a deep dive into what's really moving the needle, from unexpected surges to critical market indicators flashing red. Stick around, because this is the information that could define your next move in the crypto space. You won't want to miss a single second. Let's dive in. First up, we're tracking a seismic event in the world of digital assets, where one major player is seeing inflows surge by an astounding 10 times that of another, sparking major questions about investor sentiment and future market leadership. What's driving this massive divergence, and what does it mean for your portfolio? Then, we're pulling back the curtain on the hidden mechanics behind corporate treasuries and how their strategies are evolving, revealing a fascinating shift in influence that could be a major tell for where the market is heading next. Are these companies playing the long game, and what are the potential ripple effects? Next, get ready for a style revolution as a titan of luxury fashion makes a bold statement by embracing digital currency payments, signaling a new era for high-end retail and consumer adoption. What does this mean for the future of luxury goods, and how are other brands reacting? And finally, we're analyzing the big picture with a look at institutional buying trends, uncovering how corporate acquisition strategies are now overshadowing even the most dedicated miners. What's fueling this institutional rush, and is it a sign of sustained growth ahead? Don't go anywhere. Make sure to hit that subscribe button, ring the notification bell, and smash that like button so you never miss an update. Ethereum ETFs outperform Bitcoin ETFs by 10x. Ethereum is making waves as its spot ETFs are significantly outperforming Bitcoin ETFs, raking in inflows that are nearly 10 times greater. In just the first 5 trading days since their launch, Ethereum ETFs have attracted a staggering $1.83 billion in investor capital, dwarfing the $171 million that Bitcoin ETFs garnered over the same period. This impressive surge is being led by major players like BlackRock, whose iShares Ethereum Trust, ETHA, alone accounted for $265 million in the latest inflow, marking 5 consecutive days of positive growth for the fund. This performance has analysts and investors alike scrutinizing the underlying reasons for Ethereum's strong showing. The divergence in inflows is being attributed to several factors, including Ethereum's broader utility and recent positive regulatory developments in the United States, such as the introduction of the Genius Act, a stablecoin bill that could provide clearer regulatory pathways. Furthermore, institutional investors are showing a marked preference for Ethereum as a diversification tool. Investment advisors, in particular, have increased their exposure to spot Ethereum ETFs by 68% in the last quarter, now holding $1.3 billion in assets. This growing allocation by financial professionals suggests a rising confidence in Ethereum's long-term value proposition. Meanwhile, Bitcoin is facing a more challenging market environment. Technical indicators, including a bearish death cross on the MACD, coupled with significant whale activity, approximately $6 billion worth of Bitcoin moved to exchanges in the past 2 weeks, are raising concerns about potential downward pressure. Bitcoin has seen a notable correction, trading around $111,191 after reaching a recent all-time high of $124,000. Key support levels around $106,000 are now being closely watched, with a potential breakdown below $100,000 a growing concern among traders. While the 200-day moving average near $95,000 and continued ETF demand offer some support, the immediate outlook for Bitcoin appears more uncertain compared to Ethereum's current momentum. The market is keenly observing this shift, which could signal a change in investor sentiment and the perceived leadership within the digital asset space. The rapid adoption of Ethereum ETFs by institutional players highlights a growing acceptance of digital assets within traditional finance, while Bitcoin's price action underscores the inherent volatility and the need for continuous market analysis. The coming weeks will be crucial in determining whether Bitcoin can regain its footing, or if Ethereum's strong ETF performance indicates a sustained change in market dynamics. But what does this mean for the stability of major digital assets? This massive inflow surge for Ethereum raises critical questions about Bitcoin's dominance. The changing tides of corporate crypto holdings. The landscape of corporate treasuries is undergoing a subtle yet significant transformation, with institutional adoption of cryptocurrencies now demonstrably outpacing the influence of Bitcoin miners. Historically, miners, by virtue of their direct involvement in the blockchain's validation process and their constant accumulation of newly minted coins, have been a dominant force in shaping Bitcoin's market dynamics. However, recent trends indicate a powerful new wave of corporate buying that is setting a different tone for the market. This shift is not merely about the volume of Bitcoin acquired, but also about the strategic intent behind these acquisitions. Corporations are increasingly viewing Bitcoin not just as a speculative asset, but as a strategic reserve, a hedge against inflation, and a diversification tool within their broader financial portfolios. This institutional embrace is driven by a growing recognition of Bitcoin's potential for long-term value appreciation and its increasing acceptance within the global financial system, partly fueled by the advent of Bitcoin ETFs. The implications of this trend are multifaceted. For one, it suggests a maturing market where large, established entities are making significant, long-term commitments to digital assets. This contrasts with the more volatile, often short-term driven behavior that has sometimes characterized other market participants. The steady accumulation by corporations can provide a stabilizing effect, potentially dampening extreme price swings and fostering a more predictable market environment. Furthermore, this institutional adoption has a ripple effect on market perception and accessibility. As more corporations allocate capital to Bitcoin, it lends greater legitimacy to the asset class. This, in turn, can encourage further investment from a wider range of institutional players, including pension funds, endowments, and sovereign wealth funds, which are often more risk-averse and require strong validation signals before committing capital. The increasing influence of corporate buying also raises questions about the future role of miners. While miners remain crucial for network security and operation, their ability to unilaterally influence market price may diminish as corporate treasury strategies become a more dominant factor. This could lead to a scenario where market movements are less dictated by mining rewards and difficulty adjustments, and more by the strategic financial decisions of publicly traded companies and large investment firms. The long-term impact of this trend could be a more robust and resilient cryptocurrency market, less susceptible to the boom and bust cycles that have characterized its early years. It signals a transition from a niche, speculative market to a more integrated component of the global financial infrastructure, with corporate treasuries acting as key anchors. This strategic shift by corporations is fascinating, but how is it impacting the everyday use of digital currency? We're seeing luxury fashion giants now accepting crypto, changing the game for high-end retail. Gucci leads luxury fashion into the crypto era. In a move that signals a significant evolution in the luxury retail sector, iconic fashion house Gucci has officially begun accepting cryptocurrency payments, integrating digital currencies into its high-end transaction ecosystem. This groundbreaking decision sees Gucci joining an expanding roster of global brands that are embracing blockchain technology not merely as a novelty, but as a practical and increasingly preferred method for customer transactions, particularly for luxury goods. Gucci's foray into crypto payments is facilitated through strategic partnerships with leading digital asset platforms, including Coinbase Commerce and Binance. These collaborations are designed to ensure secure, efficient, and user-friendly payment experiences for its clientele. This initiative is part of a broader trend observed across the retail landscape, where companies are recognizing the inherent benefits of digital currencies, such as potentially faster transaction times and reduced processing fees compared to traditional payment methods. The adoption is also fueled by a growing segment of consumers, especially younger, tech-savvy demographics who are actively seeking to utilize their digital assets for everyday purchases, including luxury items. The implications of Gucci's decision extend far beyond its own sales figures. It serves as a powerful endorsement of cryptocurrency as a legitimate and viable payment option within the premium and luxury markets. As more high-profile brands integrate crypto, it normalizes the practice and encourages broader consumer adoption. This trend is already evident, with over 20 major global brands reportedly accepting Bitcoin and other digital currencies. This list spans various sectors, from technology giants and payment processors to fast food chains and other luxury retailers like Hublot and Tag Heuer, who have also explored crypto payment options in select boutiques. For Gucci, this move aligns with its established reputation for innovation and its commitment to staying at the forefront of digital transformation within the fashion industry. By offering crypto payments, the brand not only caters to the existing cryptocurrency holder base, but also positions itself as a forward-thinking, adaptable entity capable of meeting the evolving preferences of its discerning customer base. It's a strategic play to attract a new demographic of consumers who are as comfortable navigating the digital world as they are with high fashion. The broader economic context, including the increasing institutional interest in digital assets and the development of more robust payment infrastructure, has created a fertile ground for such adoption. Companies leveraging crypto payment solutions often benefit from enhanced customer reach, tapping into a global pool of digital asset holders. Furthermore, the integration of these technologies can streamline operations and offer a competitive edge in an increasingly digital marketplace. This development underscores a significant shift where cryptocurrency is transitioning from a purely speculative investment to a functional medium of exchange, particularly in sectors where brand image and technological adoption are paramount. Gucci's bold step is likely to inspire further innovation and integration of digital currencies across the luxury goods sector and beyond. This exciting fusion of fashion and finance is a clear sign of evolving consumer trends. But how does this compare to the massive institutional shifts happening behind the scenes in the crypto world? Institutional buying now dominates miner influence in crypto market. The dynamics of the cryptocurrency market are undergoing a significant transformation, with institutional buying power increasingly overshadowing the traditional influence of Bitcoin miners. While miners have long been central figures, responsible for validating transactions and introducing new Bitcoin into circulation, their impact on market price is now being dwarfed by the strategic capital allocation of large corporations and financial institutions. This shift is largely attributed to the growing maturity of the cryptocurrency market and the increasing acceptance of digital assets as a legitimate investment class. The advent of Bitcoin exchange-traded funds, ETFs, has been a pivotal catalyst, opening the floodgates for institutional capital. These financial products provide a regulated and accessible avenue for traditional investors to gain exposure to Bitcoin without the complexities of direct ownership and custody. Corporations are increasingly incorporating Bitcoin into their treasury strategies, viewing it as a hedge against inflation, a store of value, and a diversification asset. This institutional adoption is characterized by significant, often long-term, capital commitments, which can have a more profound and stabilizing effect on market prices compared to the more variable activities of miners. While miners sell Bitcoin to cover operational costs, institutional buyers are often accumulating on a larger scale and with a longer-term investment horizon. The influence of institutional buying is evident in the consistent inflows into Bitcoin ETFs, which have been a major driver of recent price movements. These inflows represent a sustained demand that can absorb selling pressure from miners and other market participants. Analysts point out that the sheer volume of capital that institutions can deploy means their buying activity has a more significant impact on market liquidity and price discovery. This evolving landscape raises questions about the future role and influence of miners. While essential for network security, their individual impact on market price may diminish as institutional capital becomes the primary determinant of demand. This could lead to a more professionalized and less volatile market, moving away from the speculative frenzy that has sometimes characterized its past. The trend towards greater institutional involvement signals a new era for Bitcoin, one where its integration into the traditional financial system is becoming increasingly solidified. The strategic decisions of major corporations and investment funds are now key indicators to watch, as they are increasingly dictating the market's trajectory. This growing institutional interest is reshaping the market in profound ways. Let's recap the biggest stories shaping crypto right now. And that's a wrap on today's critical updates. We saw Ethereum ETFs absolutely crush Bitcoin ETFs with 10x the inflows. Corporate treasury strategies are evolving to outpace miner influence. Luxury fashion giant Gucci is now accepting crypto payments, and institutional buying is clearly dominating the market. Stay informed, stay ahead, and make sure you're subscribed. Hit that notification bell, like this video, and follow us on all our social channels so you don't miss a single beat.